All right, so we are going to get started. I'm just going to put up my volume a little bit so that I can hear myself in case I need to hear myself. All right, so we are going to get started. Thank you for tuning in, everybody. And I hope you are enjoying these sessions. We're going over a year now on doing these sessions every Monday. So this will be interesting because the holidays are coming up, and sometimes those Mondays are actual holiday days. So it'll be interesting when I look at the dates and decide whether or not I come on for 30 minutes to do some number crunching. So today I'm excited to welcome you to Money Matters. I am your host, Hung Lu. Welcome, everybody. So we'll get going. And today we're actually going to be talking about a topic about, do you invest in real estate when the rates are going up? Now, I realize that the rates are coming down now, and that's fantastic. But there are situations where in real estate, we're not able to get the lowest rates. And sometimes even getting rates, private lending rates at 10, 12, 15% will actually make sense. Okay. And I'm going to show you how that makes sense in today's call. Okay, so before you go and run out and implement anything that I tell you, please, this is what I'm doing for my portfolio to grow it. It may not be right for you. So please, before you go and implement it, please go check with another investor, check with your mortgage agent, your financial advisor, make sure it's right for you before you go and implement it. Okay, so before I forget, okay, so we did the disclaimer. Okay, so before I forget, the monthly mastermind is happening this Friday. And so if you are interested in participating in the mastermind, there's a way for you to do that. Okay, because we hold the mastermind online and it's free at this time. Okay. At some point, it's not going to be free. Okay. So what I'm going to do is just show you where you can sign up. And there's two places that you can sign up for this. One is, let's see here. I think I can just show you this. Okay. So this is on Facebook. So if you don't want to leave Facebook and you just want to find it, here's the link here. And I will also put that into the chat for the event so that you could just follow along. And you could see there's dates going for every third Friday of the month where we host it. And so this one's coming up December the 30th. No, December the 20th. December 20th. Okay. So even though it's right before the holidays, we're still doing it on that Friday. The other location that you can go and participate is on the cash property Eventbrite page. So if you go to Eventbrite, you can sign up, follow me on Eventbrite if you want, and you can buy tickets for any of the time slot that works for you. Okay, we do record the sessions around the educational segment, and we do post that in the academy, but it's also a great networking platform as well. So if you want, come on, and it's the third Friday of every month that we do this. Okay, so let me unshare this. Okay, and I hope you guys can come because it's a great way to connect with other investors and get learn different strategies in real estate. Okay, so that is the monthly mastermind. Okay, and let me go into today's educational segment. So I've got three cue cards here because it's this idea goes across these three different cue cards. Because what I want to talk about today and share with you is why investing in real estate still makes sense, even if you don't get the lowest rate, even if you have to pay a little bit more in rate, why it still makes sense. Okay, so let me go into that right now. So the first thing I'm going to share with you is the concept of, I'm going to introduce you to my Uncle Vic. Okay, so let's see if you can see this image here. So this is a triangle, okay, and it's not my Uncle Vic. Okay, Vic is a very common Asian name, but I actually don't have an Uncle Vic. But I like to refer to this as Uncle Vic because the idea is a little bit more simpler than it looks, okay? So the V is for value, I is for income, and the C is for cap rate. And if you can remember this triangle, VIC, then it tells you basically as long as you have two of those numbers, then you can calculate the third, okay? So in this example, I'm going to show you why even if the rates are higher, why the numbers still make sense to buy. Okay, so we'll run through a couple of calculations here. Okay, so let me get rid of the Uncle Vic here off the screen. Okay, and I will bring up the first example here. So I am working on a project where we are able to force appreciate a property. Okay. And okay, so on the screen, you'll see an Excel sheet. I'm going to bring it up, blow it up. Okay. So here is the concept about force appreciation. And right now, if you are able to buy an investment property, or even if you have one and you're able to increase the value of it through forced appreciation. Okay, so I'm going to show you this one, and then I'll show you my eightplex that I'm working on in Edmonton and why, even if you have high rates, it still makes sense. Okay, so the first concept here is we're able to force the appreciation on the property. Okay, so we're not sitting passively waiting it to go up a little bit every single year. This is forced appreciation. So on one of the projects I'm working on, we're actually able to add in 5 bachelor units. Okay, think about it, 5 units. Okay, so that's what this 5 number of units is, 5 units. And we're able to get about, let's just say, okay, well, here I'm using 1,500 a month in rental income for a bachelor unit. Okay. And if you're thinking that's high, it's not high. I just rented out one of my basement units in Toronto for 16. Okay. So here I'm using 15. Now this spreadsheet is made up so that you can adjust the numbers as you go. Okay. So just for example purposes, we're going to run with 1,500 a month. And so that's 18,000 a year just for the addition of this new one unit. Okay. So now we're doing 5 units. Okay. So that's a total of $90,000 of annual income, rental income from these 5 units. Okay. So now this doesn't take into any expenses or additional expenses or anything. Because this is an existing property, it's already got other units going. We're just adding 5 new units in spaces that already exist there. So the assumption here is that there's no additional expenses that would go into operating this. If there is additional expenses, then yes, you would have to adjust the total income to account for the expenses. Okay, so let's actually just go into here and add that in very quickly here. So you're going to see me actually do some math here. So that's the total expenses, sorry, total income. Okay, so now we're going to add in some expense numbers, and in this case, we're saying 0. So here we're not including the cost to build it, okay, because that's actually outside of the calculation of Uncle Vic. Okay, so here we're going to say the expenses is 0. So then this is the net income. Okay, so that's going to be my 90,000 minus my 0 expenses, which is, so that's still going to give me 90. You enter your cap rate. So in this for this property, the cap rate's around 4.75. So now I'm just going to update this formula here because it's not 10, it's 12. Okay, so to calculate the cap rate, sorry, to calculate the increase in value, okay, it's V equals I divided by C. Okay, and the I is the income, so that's the 90 net income divided by my cap rate, which is 4.75. Okay, so this is where when I calculated this, I had to like take a seat and be like, oh, this is $1.8 million in increase in value. Okay, so by adding 5 units that didn't exist before, okay, 5 units, getting $1,500 a month, I've increased the property value by $1.89 million. Okay, that to me is 100% why forced appreciation, even if the rates go up, still makes sense. Okay, now if your rates are like 30, 40%, okay, that's where you really need to sit down and do a little bit more calculation. We're talking reasonable 10, 12, maybe 15 at the most private lending rates. Okay, so just keep that in mind. So I'm just going to put that in here as well. Okay, that the borrowing rate okay, is reasonable. It still has to be within reason here. Okay, so I'm just gonna save that so we don't lose that. Okay, so that is one great thing about forced appreciation, even if the rates are going up. Okay, so that's why I'm still a big believer that even if the rates go up, you still want to look at your opportunities, especially if there's forced appreciation like this. Okay, now the thing to keep in mind is that we're talking about 1,500 for 5 units. Well, let's run the analysis to say, okay, well, what if it's not 5 units, but what if it's just 1 unit? Okay, so let's go into one. Okay, just by doing this 1 unit, you're increasing your property value by $378,000. Okay, the cost to add in another unit, okay, is not going to cost you $300,000. Like at the most, maybe 40, 50,000 at the most. Okay. Like you're putting up a couple new walls, adding a bathroom, kitchen, okay, doing some like that type of renovation. You may need to update your electrical. Okay. But at the end of the day, it's not going to be $300,000 to add in another unit. Okay. So this totally makes sense if you can get $1,500 for 1 unit. Okay. So now one of the other strategies is taking, let's say, a large 2 bedroom or a large 1 bedroom, adding in a wall and renting and then converting that to a bigger unit, meaning like you take your large 1 bedroom and make it into 2 units, or you take your 2 large bedrooms and make it into 3 units. Okay. So with that, you're basically renting it out by room. So let's just say instead of 1,500, you might only get $1,000 for that extra room. Okay. So even adding that extra room and renting it out to students or to a couple. And just by increasing the rent by $1,000 a month, and if you only do this for 1 unit, okay, you've increased your value by $252,000. Okay, so we're not even adding a kitchen here because that already exists. What you're adding is a couple of walls. Okay, and a door and a doorknob and some electrical. Okay, so the cost of that is not going to be 20,000. Okay, so it's not going to cost you 250,000 to do it. Okay, so this is one of the reasons why it's such a great thing to do. Okay, so now let's go into the second example that I have. Okay, and this one is relevant to another property that I'm doing. Okay, so let's go into the share. Okay, so this one here is, let me see here. So I'm going to increase the spreadsheet a little bit here so that you can see. Okay, and you know, I call this the Peter to pay Paul scenario because basically what I'm doing is I'm looking at whether or not I can borrow funds from one of my other properties and to pay for another opportunity. So I'm leveraging property for another property. Okay. So I'm not selling anything. I'm just refinancing, pulling out equity, doing whatever I can, right? Okay, so here is the idea here. So I'm going to borrow $250,000, okay? And I'm going to borrow it for 6 months at 12.95% rate. Okay, so this is private lending money. Okay, so I I I know a lot of people who are like, Hong, that's insane. There's no way I'm borrowing money at 13%. Okay, and that's absolutely fine. But this is what I want to show you. So I'm going to borrow 250. This 250 is going to allow me to build something that's going to be worth $2 million. Okay, 2 million. Okay, so it's going to be 18 months to build it out. Okay, but at the end of it, I'm going to have a $2 million asset. And as long as I have mortgage pay down, okay, that $2 million is going to be paid for by somebody else, which is the tenants. Okay. So this is another example of forced appreciation. Okay. Even though I'm borrowing money from Paul, borrowing money from Peter to pay Paul. Okay. So I am doing forced appreciation on this piece of land that I have in Edmonton because it's there. Okay. And I already have it. It's a single family house. And at the end of the forced appreciation, we're going to have an 8 unit apartment building. Okay, so the the rate is set by the lender. Okay, so the calculation here that I just did is calculating what the interest per month is on me borrowing $250,000 at 13%. Okay. And the formula is the amount times the interest rate divided by 12, which is the number of months. Okay. So the cost to borrow this money every single month is about $2,700. Okay. Whew. Okay. So that's a lot of money to be dishing out in interest. Okay. Especially when the property isn't rented out to tenants. Okay. So here, what I'm calculating is what I'm doing is I'm trying to figure out, okay, do I need to pay this $2,700 out of my own pocket every single month, or can I borrow from somebody else, okay, like my line of credit or another property and pay Paul? Okay, so I'm basically borrowing money to pay another to pay the interest, okay? And so what I found was this actually doesn't make sense to do that. Okay. And so the way I did this was, okay, so I have the 250,000 that I'm borrowing. I have to pay 2,700 out every single month. And so I have a running total of the income, sorry, of the interest that I'm being charged, right? So 2,700, 5,400, that's the running total. The idea here is that I would go to another borrowing source at 6%, right? So I'm borrowing at 13 from Peter, and then I'm going to go to Paul, okay, and borrow at 6 to pay for that 13, okay? So then the interest that I have to pay per month on that 6% is the same calculation, 250 times, let me see, did I do that? No. So it's the interest that I'm borrowing out. So the 2,700 at 6%. Okay. And then the next month, I'm going to get another 5,400 at 6%. And I'm going to pay that out because every single month, I'm going to have to pay interest on that $207,000. Sorry, yeah, $2,700. Okay. So my running interest here is $13 a month, $30 a month, $40 a month, $53 a month, so forth like that. So then my total for the interest that I would have to pay is about $16,000, okay? Now, this doesn't make any sense because if I already have the 250 sitting somewhere else, it makes sense for me just to go and get that 250 at the lower interest rate at 6%. Like it doesn't make sense for me to go borrow at 13 and then go and borrow the interest at 6, okay? It just doesn't make any sense to do that. Okay, so which is like all my thought process in this box here. Okay, it doesn't make any sense. Okay, so now here's the other way to do it though. Okay, is that I do have access to borrow 250,000. Okay, we're going to borrow it for 6 months at 13%. Okay, so that is the original idea, was to borrow the 250 at the 13% and pay $2,700 a month. Okay. And I don't want to have to pay this for the life of the time that it's going to take us to build, which is about 18 months. Okay. So here is the idea. Okay. So the you borrow this amount and you wait and you basically carry this loan, okay, for 6 months, okay, because the CMHC construction loan is going to kick in at the 6 month mark, okay? And the reason why I'm saying 6 months is because that's how long it's going to take us to get engineering drawings, permits, go through any demolition, the asbestos abatement, everything like that. And also because winter in Edmonton, okay, you don't want to be digging or doing stuff in the winter time in Edmonton unless you really have to. So this will take us till about April, May timeframe. Okay. So I've added a couple of buffers here. Okay. So at 6 months. Okay. So I'm going to borrow 250,000 at 6%, sorry, at 13% per month. So that's the $2,700. And that is basically just my 250 times my interest rate divided by 12, okay, to get me my 2,700. So my running total there is the 2,700. Okay, I'm borrowing this at the 13%, what we talked about. Okay, so then this interest rate here, so I'm basically borrowing more interest here to pay for that. Okay, so what I'm doing here is my running total, I'm going to borrow that at 13%. Okay, and I'm going to pay $30 here. So the total that I'm paying in interest is 2,800. And I'm going to do that each month. Okay. So every single month I have to pay 2,700 for the loan that I have. And then I'm going to go and also borrow the interest to pay for that at 13%. Okay. Now, if you're thinking, well, Hong, why are you borrowing at 13 to pay your interest when you could borrow at 6? Yes, I can. Okay. Absolutely. Yes, I can. But I want to show you why, even if the rates are higher, why it still works to execute. Okay. So here we are at, okay, so then every single month you're going to borrow money to pay for that interest. Okay. And so then at the end of your 6 months, okay, it's going to cost you just about, you know, a couple $100 there extra on top of what you've paid. Okay. So this is $16,800. Okay. So it's going to cost me $16,000, $17,000 to borrow this 250 for 6 months. Okay. If you think about it, it's going to cost me $17,000 to borrow this money for 6 months. At the end of the build, okay, that's all I have to put in. I don't have to put anything more after that because at this point, the CMHC construction loan kicks in. They will cover the rest of the costs to build. They will actually pay me back my 250 so then I can just pay this loan off. Okay, so at the most, worst case scenario, I've added in an extra 3 months for whatever delays. Let's just say there's another 3 months of delays. At the most, it's going to cost me $25,000. Okay. It's going to cost me $25,000 to borrow this $250,000. By doing this, one, okay, the CMHC loan will kick in, and then I don't have to worry about anymore about carrying this interest loan. Okay. But the other great thing about this is that I don't now having gone through this calculation, I don't have to give away 50% of the equity, okay, in the ownership of the land. I don't have to give away 50% of it to a joint venture partner. Okay, think about that. I'm spending 25,000 to save 50%. I'm saving $1 million from not having to give that away to somebody else. Okay, so the other thing that I want to point out to you here is that a typical construction loan from CMHC is usually about 10%. Okay. And that's what I'm sort of wanting to point out with today's session is that, you know, a normal loan through an A lender would be around 10% for construction. Okay. I have to go and borrow it at 13% temporarily to get this project executed. Okay. At the end of the day, it's not costing me 13%. It's actually only costing me the delta of those two things. Okay. So it's actually only costing me an extra 3%. Okay. So that's why when you're thinking about interest rates going up, okay, if you're saying, well, Hung, the interest rates are like at one point, like the prime rates, went up to 5%. Okay. And if you're saying, well, Hung, I don't want to get into real estate. I don't want to go get a mortgage because I have to pay 5%. I want it at 3%. Okay. Well, here's the way to think about it. Yeah, this is the normal rate that we want, right? Like this is what we want. But to pay an extra 2%, okay, that difference, that delta, 2% gets you in the market and it gets you forced appreciation, passive appreciation, mortgage pay down, okay, and cash flow. Okay, for that extra difference, that 2%, you're getting all of the benefits of real estate. Okay, so that is why for me, even if the rates go up, it still could make sense to get into real estate. Like as long as your numbers work, it still makes sense to get into real estate. Okay, so I hope that makes sense. If you have any questions, I'm just going to make sure that I am um that I covered all of my stuff here. Okay, so this one's done, yes. And we talked about the bachelor increases. And yeah, so the amazing thing is, with the other one here where we talked about the forced depreciation here, when every single year I get to increase my rents across the board. Okay. And so it's not a lot. Like my portfolio in Toronto only gets maybe 2.5%. Okay, but my portfolio in Alberta gets a little bit more. Okay, so even if I can increase my rents by $500, okay, across the board for my Toronto properties, let's say I'm increasing it by $500 a month because I've got multiple units, and so that rental increase has gone up. Okay, that is an increase. Okay, now Toronto, you know what? I actually don't even know what the cap rate is in Toronto. I think it's actually less than this. Okay, so just by increasing my rental, my existing rents by $500, okay, across the whole portfolio, I've just added $126,000 to my net worth. That's basically what this means. Okay, hands down. Okay. So now if the cap rate in Toronto, let's say closer to 3.5, okay, I've increased my net worth on paper, okay, because it's only on paper until I sell, I've increased it by $171,000. And I didn't have to do anything because I already own the property. I'm basically sending out rental increases, yeah, the rental increase amount to the tenants 90 days before it actually happens, right? That is pretty much the only thing I'm doing. And then communicating with the tenants if there's any issues, because some tenants are struggling, paycheck to paycheck, right? So that is the extent of what I would be doing for the $500 a month in increase. Okay. And yet the huge, massive increase to the bottom line is $171,000. Okay, so if you are not floored by this calculation, reach out to me. Okay, this is a complimentary call with me, and we can chit chat about real estate and how to get you into real estate because the numbers work. Okay, thank you everybody for watching. Have a great day.